think we can start in 1 minute. Okay, let's start. So today we're going to look at market participants. So who are those people who trade on markets, why they do that, and why they win money or lose money, how they earn money, how they lose the money. And so what is a market? Market is a place where people, traders, gather to trade instruments. So it's that simple. So for example, if there is somebody wants to buy potatoes, they could attend a potato market, or they could attend a vegetable market where they have markets of potatoes and cabbages and any other things that are being sold and bought. So, and further, with the classification we're going to see, oh, 1 moment, we should keep in mind that trading is a zero-sum game. So I think most people are interested in making money on markets. So it's very important to understand that when you're making money, somebody else is losing money. So it's important to understand why somebody else is losing money and why you are making money. So what happens so that some other person is willing to lose, whereas you are winning at their expense, right? So yeah, we'll take a look at this. There are many ways to classify all the different participants on the market, and by classifying them, we understand better what's happening, why things are happening, and what is the motivation and the goal for every participant. So, for example, we could say that all the market participants, all the traders, all the people, right, could be divided into 3 categories. So first, oops. Oh. So is it proprietary? It is proprietary. So proprietary traders are those who trade themselves, right? Who decide they trade. Also, there are agency traders. Agency traders are those who trade on behalf of other people, right? They execute other people's wills or orders, right? So, for example, brokers, they don't trade themselves, they trade on behalf of their clients. And there are trade facilitators. So those are people and organizations that make sure that trading happens. They build the infrastructure for trading, they build the framework and the venues where it happens, right? So trade facilitators are also participants on the market, and among them are exchanges, clearing houses, depositories, regulators, right? So you could say that these are the 3 categories, and we are most interested in these traders because they have their own motivation to trade. So they're willing to trade to win and lose. And let's see what different traders there are on the markets. So again, there are three important groups of traders. First is the utilitarian traders. So let's list all three. The second one is profit oriented traders. And the third one is futile traders. So what are their differences? So utilitarian traders trade on the markets because they receive some utility from the markets beyond the markets. So they attend the markets not to win something on the market, but to get something outside of the market. And that's why they are willing to lose money. So basically, when they trade on the market, in average, they lose in trading because they don't want to win on the market. They want to receive some utility outside of the market. Second group is profit-oriented traders. They are the people and companies who actually participate on the market to win money. So their trading their goal is to win money from other market participants, right? As we mentioned that markets are zero sum. So somebody's losing, somebody's winning. So these guys, they are winning from other people's that lose money, and that's their motivation. So they wouldn't do it if there was no way to make money on the market. And I have a question here. Agency traders are money managers. It means the same. I mean, it's a broad category, right? So agency traders are those who don't decide themselves that they want to make some trade, to buy something or sell, but they are compelled by an agreement, for example, right? Or by an order from another, from their client, right? So for example, if I'm a brokerage company, I cannot trade on behalf of my client myself. I cannot decide I want to buy you some shares of Microsoft, right? I only make the purchase when my client sends an order that they want to purchase. So in this case, as a broker, I'm an agency trader. So I don't have my own will in this transaction. I don't choose when to trade. My client chooses, and I do the trade for them. So back to the classification with the blue lines here. So profit-oriented traders, they trade for profit. Utilitarian traders, they lose money to receive something in return outside of the market. And futile traders are those who don't receive any utility, and they also lose on the market because they don't have the capacity to make profit, right? And we'll take a look into that. So what utility do utilitarian traders receive? What are the different categories inside this group? So first one is, investors. So what do investors do? Like, why are they trading on the markets? The goal of an investor is to move money in time from the present to the future. So they have some money now, and they want to move the money to the future, to save it, right? To conserve it and to receive the money in the future. So that's what investors do. So they are using the market to transfer money in time from now to the future. There are borrowers, those who borrow money, right? Or some assets. These guys do the opposite of investors. So they are transferring money from the future to the present. So they use the markets to transfer wealth from the future to the present. So they don't have the money now, but they can borrow it now and repay later. So they are transferring those future assets that they would have to the present. And since they are utilitarian traders, as we mentioned, they are losing money on the market. So they are not making trades to win on every trade, right? They are paying the market to receive the utility of transferring money in time. Next, we have hedgers. These people trade on the market because they want to trade risks. They want to reduce their own risk, so they are willing to sell the risk to somebody who's willing to buy, or vice versa, right? I have a question here. What utilities outside the market can utilitarian traders receive? Oh, yeah, we are answering it. yeah. So there are subcategories. So by knowing the what the different people want, we better understand how it all works, right? So if we know the classification. So hedgers, back to hedgers, they, so probably it's better if I do some examples, right? So for example, if I'm going to travel abroad and I'm not sure what the currency rate will be in the future, right? I could arrange an agreement with somebody that they would buy the money for me and then I would receive it, right? Before, is it so? Probably it's asset exchangers, right? Then the next. So, I mean, there are different ways to hedge risks, right? Especially in our work, we're doing a lot with risk management. So let's move forward. Maybe we can think of a better example later. So what I mentioned was asset exchangers. So these people exchange what they have for what they want. So for something that they value more. So for example, if you have some dollars, but you're traveling to Europe, you value euros more because you would be using the cash to purchase something, right? So you sell your dollars for euro, and this way you participate on the market and you get what you value more, the euros. And at the same time, you're losing money because you are a utilitarian trader and you pay the market for the service it provides to you. Next category is gamblers. So these people receive entertainment value from the market. So they gamble, they play the game for the thrills, right? They like it. So like betting or like sports betting, right? Or what else? Like casinos. So these are the people who are ready to lose money to entertain themselves. A lot of them are there, and we should also understand that this classification is like a pure separation, but in reality, no person is a single category, right? So there is some mix involved everywhere. So there could be an investor who is also gambling. So they like the game so much, they gamble with some stocks, for example, or some bonds, whatever, which they don't expect to, they cannot expect to make profits, but it excites them, and they get a lot of pleasure from that trading activity. I have a question here. This is valid for any type of financial market, right? Yes. So this is the classification of people that participate in any market. Yeah. I don't get how borrowers correlate with trading. If they are borrowing money as credit, how is it trading? For example, when you are doing a short selling, right? You are borrowing some shares from your broker, right? So this way, I'm not sure if it's considered borrower in this case, but it could be, right? So if you're selling something that you don't have, your broker could lend it to you. Another way is, for example, the company, by the way, the entire financial instrument of bond is borrowing, right? So, for example, when a company needs money, it sells bonds. It's an instrument that they're basically lending, borrowing money from the market, and the traders who buy the bonds, they give the money to the company so that it can do its activity, and they expect to get repaid in the future. So this is like investors give money to the borrowers in this case. So actually, yeah, the entire market of bonds is investors and borrowers exchanging money with each other. What exactly do hedgers do? Maybe you have more examples. Okay, it's a good question. I dodged it at first. So, for example, if you're a farmer, right, and you're growing potatoes, right? So you plant the potatoes in spring, and you expect to collect them, to gather them in autumn, for example, right? So, and right now is spring, for example, and you need to know how much of potatoes you want to plant. I mean, how much you would be able to sell in the future, right? Because if you plant too much and you wouldn't be able to sell it, your potatoes will be gone, right? Or maybe the price would drop and you would have to sell the potatoes at a price which is cheaper than how much you paid to plant them, right? So you can, as a farmer, you can hedge your risk by purchasing, for example, futures, right? So you could purchase a contract which says that you would sell your potatoes in autumn at this price, which is determined right now. So this way you can fix your price beforehand. You don't know what will happen to the price in autumn. You don't know how much potatoes you will have grown, right? But you can purchase these contracts, and you know that you will sell at least this amount of potatoes at this price, which has been agreed beforehand. And after you have made the contract, you can proceed to plant the potatoes because you know how much you would need in autumn. So this is an example of hedging for farming, for example, right? Same is if you're a factory and you need, I don't know, oil, like you're making something out of the oil, you're making oil products, right? And you have to do a continuous process, right? You cannot stop your factory. If you stop it, things break, for example, right? And you would lose money on salaries for people who don't work, or maybe some hardware that you have, it requires constant operation, right? So you need to have supply of oil constantly during the year, maybe this year, maybe next year as well, right? So you would need to, if you didn't have hedging, you would need to buy the oil at the price that will be in the future. But how do you plan your operations if you don't know what the price of oil will be in the future? So by hedging with future contracts, you can agree that you will buy next year at specific date oil at some specific price. And this way you hedge your risks. You know that the price will not skyrocket, so you know beforehand how much you will pay for the oil, and you will know how much capacity you would need to process this oil. So these are the examples of hedging. I hope I answered the question. So you hedge your risks by using financial markets with the other people who probably also need to sell the oil or to buy the potatoes to make something else, right? So we are going back to gamblers. I hope gamblers are understandable. So these are people who extract entertainment value from the market, from trading, and lose money. Next are so-called fledglings. So learners, right? So these are the people who are trading on the market who don't know how to trade, but they are trying different things. So when you are just starting in a career, in trading career, you will make mistakes. You will need to try different things, different strategies, different to see how the instruments work, right? So you trade because you gain the utility of learning from the market, and you lose money, right? So you pay for the utility you receive and you lose money. Any questions? No. Next is we have more obscure, I would say, categories, but we need to put them here so that we have the full picture. Cross subsidizers. So these are the people who make the trades to gain some rewards or bonuses from their broker, for example, right? So they make trades not to profit from the trades, they just need to make some volume, or they need to trade specific instruments to get rewards. So this is the reason why somebody would get some benefit from the outside of the market while trading on the market and losing money, right? So for example, if you are a money manager, right, and you receive some kickback bonuses like tropical vacation from your broker, if you make enough trades during this quarter, so you would make those trades just to hit the limit, and you get your vacation while you are losing money, right? So you get utility, you pay for the utility by losing money. Another any other questions? It sounds like I do actually have to trade oil or potatoes to trade futures. Does futures trading mean that you're actually purchasing something solid? Not always, right? But in the case of farmers using futures to hedge risks, yes, right? So maybe they don't even trade actual potatoes, right? But they at least can offset their financial risk, right? Right. So for futures, you don't have to always deal with the actual potatoes or oil, but you may if you need to. And in the case of hedging for farmers, which is like simpler to explain, I think it makes sense. Okay, so and the last category I have here is tax avoiders. So these are the people who could use the market trading to avoid taxes or to minimize taxes, right? So, for example, they could purchase approximately the same asset. They could both buy and sell it, like go long and short on the asset. And after some time, they could close the losing position to offset with the losses the taxes that they would need to pay. So if you have losses, you can deduct those losses from your taxes. So by making sure you always have some lossy positions that you can close, on which you don't really lose money by itself, right? You can this way offset some taxes that you would otherwise pay. So tax avoiders make those trades to make sure they receive reduced taxes, and at the same they get the utility from the market, and they also in average lose money. Yeah, no, I mean avoiding taxes is not something bad, right? The tax system is specifically, it says do this to reduce your taxes. So mostly all people who have money, they do exactly what they're told to do, right? So if the system says do this, they just do it and they reduce the taxes. That's why rich people usually don't pay that many taxes, because that's expected of them. So the system is in a way made in a way that this happens. Yep. Yeah. I mean, he probably pays enough taxes, right? But probably not the same percentages from the salaries that they make, right? As his employees. Okay, so we've taken a look at the utilitarian traders. I think this is the entire classification. Maybe there are some other things, but in the book I read, we have only these, and I couldn't think of anything else. So let's take a look at the profit-oriented traders. Who are the people making profits and why they're making them? So profit motivated traders, they like what makes them profit on the market is that they know what service they provide to other market participants or what their advantage is, right? So somebody is willing to lose money to you. It means that either you do something useful for them or you have some advantage that they cannot avoid. And that's why by having that advantage, you make money. And this is what separates profit motivated traders from futile traders. So if you don't have an advantage and you don't offer any specific service on the market, you are going to lose money, right? Why would somebody else lose money to you specifically if you don't do anything useful, you don't provide utility, and you don't have any advantage? The book, I will link the book in the description then, right? It's a great book, and but it's very large. So I encourage you to read it. Just it's pretty large. So profit motivate traders are as follows. We have speculators. Speculators. So these people profit, they have an advantage because they profit from information that they have about future prices. So let's take a look at what the different classification, different categories of speculators we have, so that maybe it's more clear, right? So what are the speculators? We have value traders. These are people who know how much each asset actually has to cost, how much each asset costs, right? So they know the price, the actual current or future price of the asset. How do they know it? They analyze information, and by applying their understanding of, for example, the market, the companies, and maybe specific details, they can calculate how much something costs, right? Perfectly how much it would cost, and they compare it with how much it currently costs. So if it's cheaper, they buy it. If it's more expensive than how much it should cost, they sell it. Any questions on the value traders? So for example, you could calculate how much a company costs, right? You could download its, if it's a public company, you could download its reports, financial reports. You could read them. They are readable. They are made for people who actually read them, right? So if you know accounting, you can read the reports. If you also know the business that the company does, so for example, if it's a car making company, right? If you know enough about the process of how cars are made, and you probably worked for like 10 years in a car making company, and you know how pieces fit together, right? How the processes work. You could look at those numbers and you could understand the dynamic inside of the business. You could predict what would happen in the company, right? So for example, if you know that the company has a bad management or they are making mistakes, the company would probably lose money over time. I mean, it would cost less over time. If they are making really good management decisions, and from your experience, you know that they would affect the company in a positive way, then you can expect that the numbers would grow, right? And it's more complicated than this probably, right? But also it's possible. It's just a lot of it takes a lot of time and a lot of knowledge and a lot of experience, which not many people have. I don't, but many people analyze companies and trade stocks, for example, based on their analysis, and they make a lot of money because not that many people know how to do that. A question here: what type of trader are you? I'm mostly from the third category, futile traders who lose money. Potential company prices are expectations which may not come true. I believe yes or no. Yes, right? And some people know better whether something will become true or not, and that's why they would better know what is the future potential price. So value traders, they estimate so-called fundamental values of companies. Companies' assets, right, of oil, for example, of gold, if they know the business, if they know the asset, have a lot of experience with it, they can more easily predict the prices, and they can put the proper coefficients in the formulas based on their experience. Next is the news traders. So these guys profit because they are the first to trade on some new information. So if they know some news before other people, like before all the other people on the planet, they trade on that information, and they can predict from the news whether the price will go up or down, right? So their advantage, which advantage they're using, is that they trade the news the first on the planet. They have access to the fastest information. Okay, we have information oriented technical traders, whatever, right? So they do analysis on the patterns, right? So the technical traders, we were talking about a technical analysis. We were talking about last lesson. These are one of those guys, right? Who use it. Their advantage is that they have access to a lot of information and computing resources and knowledge how to process those pieces of information, how to gather them, and how to make predictions based on that information. So it's also very difficult to do. You need to have a lot of very smart people. You have to make investment in hardware, in software, etc. So not that many people can afford to do that, and usually it's companies, rather big companies, who employ a lot of mathematicians, etc. Next we have arbitrageurs, the guys who do arbitrage. So if there are multiple venues trading the same instrument, they buy where it's cheaper, they sell it where it's more expensive, and so they basically, the service they provide is they connect buyers and sellers across different markets. So if you have a London exchange, you have New York exchange, essentially the arbitrageurs offer the connectivity between two separate exchanges in two different places, and buyers and sellers can enjoy the same prices everywhere due to their trading. So they offer this kind of service due to having the technical ability to do that, right? And they and due to the access that they have and they pay for. We also have different so-called parasitic traders. Those are order anticipators and bluffers. So order anticipators trade on the information that they have that some trading will happen in the nearest future, right? So like front runners, for example, right? For example, if you work in a brokerage company and your large client calls you and says, I would like to buy like a lot of shares of Microsoft, for example, right? If you like buying a lot of shares of Microsoft will move the price up, right? And since you know that, you could, while talking to the client, make a small trade yourselves on your own account, right? This way, you front run your own client and you buy at a cheaper price that will be after you fill the client's order. and after the client's order goes through, the price goes up, and at that point you can sell your position and you profit from it. Of course, this is very illegal, right, to do, especially if you're an employee in a brokerage company, right? But this is something that you could potentially make money on, but this way specifically is very illegal. You never have to. You should never do that, of course. And but after the fact, you get to know that so many people got their money also on these kind of things in the before times, right? So nowadays it's all regulated, etc. But like 50 years ago, 70 years ago, it was much more prevalent. Also, bluffers are traders who manipulate the market into wrong conclusion, right? For example, somebody could spread rumors about some company, right, or their executives, so that they could, by spreading this information, whether true or false, they would manipulate the prices to go in the direction that they want and profit from that, right? So they have the advantage of moving the prices by spreading some information. And these conclude the speculators. We also have dealers. So dealers are traders with whom the clients can trade at any time. So, and the dealers, if they buy from some clients, they try to sell it to some other clients. So they kind of become the intermediary for the trade for some time until they can find the buyer for something that they bought themselves. So they try to they offer to their clients an ability to trade at any time, and they solve they let the client solve their trading problem if they want to trade at some time, and the dealers take the problems to themselves and solve the problem themselves later. So if they bought something from somebody, they later find somebody to sell it to. And for this service, for offering liquidity, the ability to trade to their clients, dealers also make money because they buy cheaper than they sell in the best case, right? So that's why they are making money. Any questions on dealers? Okay, so these are the two categories of those who make money on markets, right? Speculators and dealers, these two. And we have the third category of futile traders, also known as irrational traders or fools. So these people lose money for different reasons. And let's take a look at the classification here so that we know for what reasons they lose money, right? First is inefficient traders. Efficient traders. So these guys, they lack skills or resources to trade profitably. So probably they have good ideas, but they don't have enough skills to implement them, or they don't have fast enough connection to the trading venue to actually take advantage of their strategy, right? So the inefficiencies of the market, they become higher than their potential profits. That's why they lose. Or maybe they trade with unfavorable commissions, right? So the guys who lose on the inefficiencies of their trading, we have pseudo informed traders. So these traders, the value traders and the news traders, are informed traders. So they have information about the actual price of assets or how it changes, right? In the case of news traders. And pseudo-informed traders are those who think they have some unique information or some new information or result of some analysis, but in fact, the information might be old, right? So they read some report, did some calculations, but the report was 2 months ago and things have changed, for example. So they act as if they are informed traders, but their information is old. Or like, for example, if they are a news trader, right? But they are not too fast to be the first one on the planet to actually trade on that information. So they, as a result, will lose. And we have victimized traders. Victimized traders. So traders who were made victims by their broker, for example, or by their financial advisor. So they trade not because they made some analysis. They don't have any advantage in trading. They don't have fast execution. They don't have 100 math majors, right, doing the calculations. They don't have millions of dollars to hold inventory for dealing, right? They don't have nothing, but their broker told that this is a good idea to make this trade, right? Or they have a financial advisor, or they follow some influencer who said that this is a good trade, like you should buy Bitcoin or you should buy Apple, right? So these guys don't think things themselves. They receive some advice and they act on it, but it always, like in average, okay, not always, the markets are random, right? You could win even if your strategy is bad, right? But in average, victimized traders lose because they have no reason to win. So all the reasons to win are here, right? This is the entire list. If you are not one of these, if you don't have qualification to do these things, if you don't have the information, not resources, if you don't know what exactly you're doing, you're probably a victim of somebody else who's making money on you. Or we have the rogue traders. For example, in this category are the people who make trades to cover their mistakes, right? So, for example, you could trade options, sell options, the financial instrument of options, right? And you could sell the options to make profits out of thin air with a very high risk. So if, for example, if somebody is trading, managing some money, trading and making losses, they may decide to cover those losses by making some risky trades. And so they're going rogue in this case, is that they're not working, like not doing their part of the contract, right? So they have to be on the side of the trader, but they are trading against the interest of the trader to cover their own inability or loss of skills or unlucky situation, right? So they make additional lossy trades and they lose in average. So these are the categories of traders, the market participants that we've covered. Do you have any questions? How fast execution is supposed to be? Very simple. You have to be the fastest on the planet. If your advantage is making fast trades, you have to be the fastest. Otherwise, you don't have an advantage. Somebody else who is faster than you will have the advantage and will make the money and you will lose. Any other questions? Okay, I think we don't have any more questions. And I think today we're still beyond the schedule that I would want. I would like to stay under half an hour for the next time. So thank you for attending the lesson. If you have any questions, ask them in the comments. Don't forget to like and subscribe. And see you later. Bye. Oh, wait, how do I do this?